Hello, everyone. This is Rob McDougall from Zhang Financial here with your weekly economic update. Today is Tuesday, March 11th, 2025. As you might hear, got a bit of a cold, so I missed yesterday, failed to get the podcast out. We're going to do it today. And in hindsight, of course, we had a very poor equity market yesterday. So we'll talk about things that are leading into that and contributing to market instability in the equity markets here in the U.S. in a few moments. Let's just go through the economic calendar last week, and then we'll take a look at the returns from last week. So last week on Wednesday, we had the ISM Services PMI. Now, this had been running in the 50 to 55-ish range, closer to 55, and most recently has come down. So you may recall for the PMI indexes, both the services and manufacturing, the 50 level is the limit between up and down. So below 50 means slowing, no growth, or decelerating. Above 50 means growth. For the services index last week, it came in at 50.3. So pretty close to that demarcation line. The expectation is it would come in at 50.5. So roughly in line, but dangerously close to slipping into the deceleration or negative growth area. Last week also, initial claims came in actually better than feared. So the week before, we had a glut of unemployment claims well above expectations. So last week, the expectation was raised, expecting 235,000. Actual was only 221,000, so a favorable input there. Then on Friday, a slew of numbers. The non-farm payroll numbers, that's really, to me, the key one from last week. The expectation was 160 new jobs created in February. Thought that was a little aggressive. We were pleasantly surprised to see it come in pretty close to that. It came in at 151,000. So that actually to us is good news. Unemployment rate actually dropped 0.1%. We don't put a lot of stock into this number because it can bounce around quite a bit given individuals' desire to look for work. So still good to see it go down. It's now at 4.0. Expectation was 4.1. Then average hourly earnings, average hourly earnings, both on a year-to-date, trailing 12-month basis and month-over-month basis came in almost exactly as expected. For the month-over-month of February, it was positive 0.3. Now, with all that economic info I just gave you, which is not earth-shattering, doesn't look like it would move the needle, but for the Atlanta Federal Reserve, they're seeing maybe they have a crystal ball. Now, we've mentioned we followed the Atlanta Federal Reserve for several years. They're better than the bulk of economists. So we always show this slide that has where the Atlanta Federal Reserve is, and then the blue chip economists index. And usually the Atlanta Federal Reserve is more optimistic than the rest of the economists, the consensus, and that has played out really well over the last 2 years. So they've been much more right than wrong. But we do have to question the fact Federal Reserve Atlanta now thinks GDP for the first quarter is going to come in at a negative 2.4. Maybe right. We're definitely seeing numbers that are weaker economically, but that is a massive drop from the fourth quarter, which was, off the top of my head, positive 2.8. So for the economy to turn around that quickly, maybe they're right, kind of doubt it. But just a week ago, they had expected a decrease in GDP growth or a negative GDP growth of negative 1.5. Last week, they doubled down and they think it's going to be negative 2.4%. So a lot of this probably just guessing. The economic data doesn't really show any sort of drop-off like that. At the margin, definitely weaker economic activity, no doubt. But we're going to have to guess the Atlanta Federal Reserve and the markets are reacting to the President Trump and their administration and DOGE and their effort to rein in spending. And particularly over the weekend, I believe it was, President Trump mentioned the fact that we'll probably have to take a little short-term pain for long-term gain. I would say for people that have been around for a while and are looking at the fact that we're running $1.8 trillion to $2 trillion deficits, that we can't do that forever. So this has to happen. And it really shouldn't be a surprise. And what has been discussed so far are really modest cuts, and it's a low-hanging fruit. So we haven't even got to the tough part of cutting spending, and we've seen the equity markets. Last week, we'll take a look at those numbers, but then yesterday, negative as well on Monday. So we take a look at the GDP numbers, and we take a look at what we were running coming into this year, that 2.8% at the end of last year, 2.5% at least for the full year. So GDP growth probably slowing. It may go into recessionary level. What happens in this environment is both consumers and CEOs, they become less optimistic, and particularly CEOs. If they pull back on the investment spend, you can get the economy to turn around in the short term. We just strongly encourage clients, myself, not to overreact to it. So short term, yes, we see the markets down yesterday. They were down last week. We'll go over the numbers. But in terms of market timing, whatever's going to happen will happen. And for anyone that thinks they can say now is the time to get out, that individual will most definitely not tell you when to get back in. And we have two real near-term data points on that. And that's 2022 was a huge down year for all markets. Equities down, value held up well. It was great, but equity markets down, fixed income markets down. And who would have thunk that 2023 and 2024 would have been 20% plus gain years consecutively? And then we go back to early COVID. And I use these numbers all the time. February 3rd to March 23rd, S&P 500 dropped 34%. And things looked lost. At March 23rd, we did not have government programs in place to combat the slowdown, the shutdown of the economy, essentially. And yet that was the bottom of the equity markets and took off from there. So, year to date, we'll take a look at those numbers. But the economy is decelerating for sure, but it doesn't look like a free fall by any means. So we'll look at the inflation expectations. So if the market were no growth in the future, you would expect the inflation expectations to tank. Now they have gone down. They were up about 2.44% for the expected 10-year inflation. Last week that dropped down to 2.33%. So not much to talk about there. Fed funds, futures market. So we do have a Fed meeting next week, and there will be a rate decision next Wednesday. 97% odds of no change. However, the numbers for the end of the year have definitely changed, and the expectation of rate cuts, that has gone up. So the odds of 2 or more cuts being enacted by the end of the year went from 59% up to 69%. And now there is a 37% probability built into the futures market that we'll get 3 or more rate cuts by the end of the year. So in terms of returns last week, tough week last week. U.S. equities, S&P 500 down 3.1%. The Invesco's equal weighted S&P, however, down 1.9%. Again, we've had a lot of discussion going back to last October, pointing out that maybe the Magnificent Seven is near its peak because its relative earnings rate versus the rest of the S&P 500 was going to be flipping this year. And it's just 1 week, obviously, but even on a year-to-date basis, that equal-weighted S&P index has outperformed the S&P 500. So last week, S&P 500 down 3.1%, equal-weighted down 1.9%. Growth last week down almost 5% here in the U.S., value down only 2%. So starting to look a little bit like 2022 in that respect. The rest of the world, developed market, ex-U.S. actually up last week, up 2.4%. Emerging markets also up 2.85%, driven by China, largely by 2 stocks in China. But China up 6.5% last week and up an amazing almost 20% on a year-to-date basis. Fixed income last week, that turned around. So we had a nice rally going. That was halted last week. So the Bloomberg U.S. Aggregate Bond Index last week was down 60 basis points. But year to date, that is still up 2.1%. So let's take a look at some of the economic data that will be released this week. Today, Tuesday, the JOLTS job number will come out. That's the number of jobs outstanding. The consensus is 7.63 million. That's about where it was the prior month. Then tomorrow, Wednesday, we'll get inflation, the CPI, and the core inflation. So the expectation there is the inflation rate, the headline number is going to drop month over month. In January, it was a positive 0.5. It'll be expected to be a positive 0.3 for the month of February. And then on the core inflation, month over month, that's also expected to drop. The month of January, that was a positive 0.4%, expected to be a positive 0.3%. Thursday, we get the same number, but for the producer side, producer price index. So the headline number, that's also expected to be down month over month. January up 0.4% month over month, expected to be up 0.3%. For February, the core number, that's expected to be in line. That's also expected to be up on February, up month over month, 0.3%. Initial, easy for me to say, initial jobless claims. That's expected to come in at 225,000. Remember the upside surprise last week, it was only 221,000. And then a very key data point, consumer sentiment coming out. That's the Michigan consumer sentiment number coming out on Friday for March. Now, the number in February was 64.7. The expectation is that dropped a little bit further to 63.3 is a consensus. So that's it for a very long wrap-up of last week. Thank you very much for attending. We'll look forward to seeing you next week. Thank you.